Welcome to IQD Dinar News, your go-to source for the latest updates on currency exchange rates, revaluation news, and insights into the Iraqi dinar. Stay informed and ahead of the curve with our timely analysis and breaking developments. The banking system, international trade, oil credits, and the role of central banks and government agencies in such exchanges. Here's an outline of how we can approach a detailed explanation of each part of this paragraph. Bank exchanges and the role of the US Treasury. When individuals go to the bank to exchange currency, it's the US Treasury that supplies the funding for these transactions, but it's essential to understand the underlying mechanisms that make this possible. The US Treasury operates as a financial backer, allowing banks to complete the transaction without risking their own liquidity in the initial exchange. This process is fully electronic, which streamlines transactions and minimizes the need for physical cash. The backing from the Treasury essentially means that the government is putting its financial credibility behind these exchanges. Electronic exchanges are a vital element in global finance, especially when dealing with high-value currencies or significant quantities of foreign banknotes, such as the Iraqi dinar. By handling these transactions digitally, banks and governments can efficiently track, manage, and process large sums, reducing the logistical challenges and security risks that come with physical cash exchanges. Once the US Treasury takes on the dinar, it becomes a US government-held asset. This arrangement gives banks a reliable funding source to facilitate these exchanges and incentivizes them to participate in the process. By acting as a broker, banks can help the Treasury acquire a substantial amount of dinar, which in turn creates a profit-sharing opportunity for both the bank and the US government. Banking profits and the value of 30 note. In this setup, banks serve as intermediaries, accumulating as much of the high denomination, or 30 notes as possible. These are the larger value banknotes, often called 30 notes due to their denomination, for example, 10,000, 25,000, etc. Banks, with the Treasury's support, aim to gather as many of these notes as possible. The reason is simple: larger denomination notes can be more cost-effective to handle, and in some cases, they hold a higher potential for value increases if the currency undergoes revaluation. The banks see this as a valuable opportunity because they're effectively able to gather these notes at a relatively low initial cost. Since the Treasury funds these acquisitions, banks benefit from collecting and holding the currency, leveraging the possibility that their holdings will increase in value if the exchange rate for the dinar changes. The Treasury, therefore, benefits from encouraging banks to gather these 30 notes, and banks benefit from the backing of Treasury resources. Treasury holdings and international banking and trade. Once the US Treasury acquires the dinar, it retains a portion of these notes to facilitate international trade with Iraq. Retaining a portion of these high-denomination notes helps the Treasury support international economic activities, especially those involving Iraq. Holding dinars also positions the US Treasury to use these assets for interbank transactions and global trade. In international trade, particularly with a country like Iraq, holding a partner nation's currency can simplify trade deals. The Treasury's retention of dinars enables them to directly facilitate deals with Iraq without the need to convert the currency back and forth repeatedly, which can be costly and complex. Additionally, Iraq's oil resources create a further strategic advantage, as the US Treasury can use the dinar to directly transact in oil and other goods, streamlining cross-border trade processes. oil credits and the value of oil-backed transactions. Iraq's agreement to provide oil credits serves as a form of collateral or backing for these transactions. Oil credits allow the U.S. to secure a predetermined amount of oil from Iraq at a fixed price per barrel, with the understanding that these transactions are mutually beneficial. With Iraq's vast oil reserves, the U.S. Treasury sees significant value in this arrangement, as oil credits effectively allow them to control the cost of oil imports from Iraq at a favorable price. The fixed-rate oil credit, estimated at around $30 to $35 per barrel, provides stability and predictability, especially compared to the frequently fluctuating oil market. This agreement is mutually advantageous, as Iraq gains an outlet for its oil and a reliable revenue stream. At the same time, the U.S. can secure energy resources at a lower cost than market rates. Profit margin from oil credit sale. Beyond the direct trade benefits, the U.S. Treasury has the potential to profit from reselling these oil credits to other countries that need Iraqi oil. This arrangement allows the Treasury to act almost as an energy broker, supplying oil at a price that remains competitive but allows them to generate revenue. By acquiring oil at a fixed credit rate and selling it at or near market rates, the Treasury could achieve a substantial profit margin. Selling oil credits allows the U.S. Treasury to use its initial currency exchange investment strategically, turning a currency acquisition process into a potential revenue stream through commodity trading. This added layer of profitability not only benefits the Treasury but potentially also reduces the Treasury's need to issue additional debt or increase taxes to fund government operations, as they're generating revenue through these transactions. Impact on Iraq's economy and global relations. For Iraq, this currency exchange arrangement benefits them by helping to stabilize and internationalize their currency while fostering demand for their oil. By tying these high-denomination notes to their oil reserves, Iraq essentially guarantees that the U.S. will continue to value and retain its currency holdings. Additionally, it creates a system where Iraq doesn't need to allocate massive amounts of financial resources to repay the U.S. directly. Instead, they fulfill their obligation through oil credits, which are a natural product of their economy. Iraq's role in the oil market is crucial, especially for countries that depend on a steady oil supply. By securing a fixed price with the U.S., Iraq ensures a consistent buyer for its oil, potentially reducing the risk of financial instability. This arrangement also positions Iraq as a more active and significant player in global trade. The broader economic implications. This system of currency exchange, oil credits, and treasury-backed banking serves multiple purposes in a globalized economy. It creates a more integrated economic relationship between the U.S. and Iraq and highlights how currencies, commodities, and governmental policies interact on the world stage. Through this model, we see how different countries can use their economic strengths, like Iraq's oil reserves and the U.S.'s financial infrastructure, to form arrangements that are mutually beneficial. Each component of this arrangement, from the Treasury's initial funding of bank exchanges, to the collection of 3-0 notes, to the use of oil credits, demonstrates the interconnectedness of international finance, central banking, and resource trading. The U.S. government's strategic approach highlights how currency policies can go beyond mere exchanges and evolve into complex, mutually advantageous arrangements that involve commodities like oil, ultimately benefiting both nations involved. This overview would lay the foundation for a deeper exploration, allowing for further elaboration on. Thanks for tuning in to IQD Dinar News. Don't forget to like, share, and subscribe. For more updates on the Iraqi dinar and global currency trends, hit the notification bell so you never miss an update. See you in the next video.